So, learning objective 3 simply gives you an understanding from our corporate perspective of the rules that govern financial reporting. And so here, Trevor, is what I was talking about: GAAP, generally accepted accounting principles. And these are the rules and practices of the accounting profession that guide how we do financial reporting. So in other words, how we actually do the accounting for corporations that need to report information to the public. Okay. And there are some standard setting bodies that actually create GAAP. The biggest thing you need to know about this is GAAP is overwhelmingly created by CPAs, certified public accountants. And the main committee that is used within the organization or the Association of Independent CPAs is something called FASB, the Financial Accounting Standards Boards. This is the group of accountants in the accounting profession that debate and discuss and resolve issues as to how things should be reported. And this is important to know. Accounting is not like static. It's very fluid. There's always things happening because there are new businesses, there's new technology, there's new other things starting up, cryptocurrencies, among other things. How do you handle that from an accounting perspective? Because we have to keep track of everything, right? And if it's a relatively new concept and it's a very, relatively new business model, how do you do the accounting for that? Because we're doing accounting one way for this company and this way for this company, and this is all part of the accepted rules. How do we debate and discuss? So there's a huge debate that's done by FASB. The government allows the accountants to basically be self-reporting, self-policing rather. They have a seat at the table. They actually have a say in how GAAP, again, which is the rules and practices of accounting, how GAAP is created. But it's mostly the accountants themselves that are discussing and deliberating and deciding these things. There's a period for public comment. It's a relatively open type of thing. And you can look up FASB. You can Google it if you'd like. You can also Google the AICPA, which is the Association of Independent CPAs, and see their involvement in creation of GAAP as well. GAAP is simply US standards. That's important to know. The rest of the world, when I say the rest of the world, it's more than 115 countries now. The rest of the world uses accounting standards called IFRS, the International Financial Reporting System, or standards. And IFRS and GAAP differ in some ways. They're the same in some ways. Again, just as the Financial Accounting Standards Board is the main group of accountants that create GAAP, again, the rules and practices for financial accounting. The International Accounting Standards Board is really that main group of international accountants that help create IFRS. Okay. So in terms of how these rules are created and how it's done, that's how it's done. Interesting? Yes. Will it be on a test? No. GAAP, will that be on a test? Yes. You absolutely need to know about GAAP because we're doing financial accounting for corporations. And so these are the rules for doing it. And you're learning the rules as you go. Okay, that's why a classified balance sheet is organized the way it is. That's why all those forms are organized the way they are. These are part of the rules and practices for financial reporting. That's what you're learning. Okay. Back in chapter 1, we heard about the Sarbanes-Oxley Act being passed by Congress to deal with ethical concerns and fraud. Well, nothing Congress does in terms of passing a law doesn't come with some bureaucracy. So it's, the Public Company Accounting Oversight Board is the folks, they are the folks that, from the federal government's perspective, that oversee and make sure the rules of Sarbanes-Oxley are being done. As the SEC's job is to do that for the markets, the stock market, bond market, other types of things. The SEC is the government agency that oversees that and enforces federal law regarding trading and information like that. Okay, so again, generally accepted accounting principles, GAAP, are the rules and the standards for financial reporting. They are created by and within the accounting profession. Okay. So in order for information to be considered by these accountants, there are two really, really, really critical qualities, or what they call fundamental qualities, for information to be considered part of accounting. The first one is called relevance. The second one is called faithful representation. Relevance basically means that accounting information is important in making a difference in a business decision. And so, again, accounting rules that FASB has debated to make GAAP have overwhelming arch of seeing if the information is relevant. If it's relevant, it's going to be part of the accounting information of every company. Faithful representation basically means that it's complete, it's true, it's neutral, no errors, right? And so, again, the information in the accounting record has to be true, has to be complete, and show the full picture of the company. And so that's really important. The book also introduces you to certain enhancing qualities for accounting information. So you can compare one US company to another US company. GAAP requires companies to use the same accounting principles, which is why GAAP exists in the first place. Right? So any accountant anywhere in the US can look at companies' books and see if they're following the rules. That's basically it. All the information on that accounting record needs to be verifiable, which means that an independent observer, like an auditor, which is an outside accountant or an accounting firm that looks at the financial records of another company, so yeah, they're following the rules. There's a paper trail that shows this information is true. Everything has to be in a clear and concise fashion for understandability, which is why they have to set up the balance sheet in a classified manner. All companies have to. It's part of the rules that you just learned. Companies need to use the same accounting principles and methods year to year. That doesn't mean that changes are not allowed. They just have to be allowed for very, very good reason. The government has to give permission to change the accounting records. Otherwise, consistency is assumed. And all the information that you see in accounting happened in the time period the company says it happened in. So if it's an income statement for the month of August, all the information shows everything that happened in the month of August on that statement. There's a few assumptions that are part of financial reporting. One is that all US companies report in US dollars. Now that's important because a lot of US companies are global. In other words, they sell their products internationally. They have businesses all over the world, right? Or stores all over the world. And so they're doing their financial statements as a US company according to GAAP in US dollars. That's the monetary unit assumption, okay? The economic entity assumption means that we keep the records separate from each other. And so even though you might have a company that like Ford and General Motors, we have to understand that these are separate economic entities that have their own records. It's also true on a basis of keeping the owner's personal records and the business records separate as well for corporations that are small, owned by one person, for example. The periodicity assumption means that companies create artificial time periods for reporting. Okay, again, this is about financial reporting. So they often do, as you know, the income statement is done every month. It's certainly done every quarter, and the longest period of time it will be done is a year. And so that's part of the periodicity assumption. Okay, artificial time periods, month, quarters, and years. The going concern assumption simply means we assume that the company is going to exist in the foreseeable future. It's going to keep going, right? Henry Ford has been pushing daisies for a long time, pushing up daisies for a long time. Ford Motor Company is still existence long after his demise. Walt Disney, whatever you want to say, he's dead, he's on ice, what have you. Walt Disney, I don't think he could recognize his own company, if he did come back to life. If he was frozen and defrosted or microwaved, I don't know what they do. Then basically speaking, Disney has changed a lot since he was frozen, a lot of it. What you see on the balance sheet for assets, one of the principles of generally accepted accounting principles, is that companies record assets on the balance sheet at what they actually paid for them. So even though they might have purchased a building in 1960 for $1 million, and that building might be worth a lot of money today, it doesn't matter. On the balance sheet, it's going to be there for $1 million, which is what it was purchased for. That's historical cost. On occasion, balance sheet accounts have to be tweaked because the values of assets and liabilities might change over time, in which case the balance sheet is inaccurate or overstating the value of the assets or understating the value of its debt. And so sometimes these have to be tweaked. Again, you'll learn about that in Accounting 102. Companies also have to disclose all circumstances and events that would probably make a difference in the financial statements or the users of financial statements' opinions and analysis. However, there is one thing that they have to weigh is something called a cost constraint, meaning that if they do disclose information that hasn't really happened yet, the cost of the company might be too much or much, much greater than the benefit of fully disclosing. This often happens in lawsuits. Companies sue each other all the time. There's lawsuits going back and forth. Let's say Walmart is just lost a lawsuit about labor practices, and the court said they owe these employees millions and millions of dollars in back pay and wages, back pay and benefits. Should they be reporting that? Should they disclose it? Well, part of the cost constraint would say, well, we're going to appeal this. We have a case for an appeal. So we don't have to pay it yet. We will find out through the appellate system whether we actually owe it or not. So it would actually, to disclose this information would be a disservice because the cost to the company, meaning it looks like the company is losing millions and millions of dollars, which is not happening, outweigh the benefits. And so you could have lots of adverse impact on the stock price or other types of things where is it really necessary, at this point, since they're going to appeal the case and the appellate court has not weighed in on a judgment whether they literally have to pay it or not. So cost constraint is important. And the do-it exercises for learning objective 3 are simply about what these concepts mean. You're going to get an exercise or two about this, but again, it's not necessarily going to be emphasized on the actual test, which is going to be more balance sheet, financial statement related.